PulteGroup earned $819 million in the first 6 months of fiscal 2026. Over the same 6 months, it generated just $177 million of operating cash, about 22 cents on the dollar, down from roughly 37 cents a year earlier. And it spent $681 million buying back its own shares. Those three numbers are the whole story of this filing. Revenue is falling, margins are compressing, and the cash funding shareholder returns is coming out of the balance sheet rather than operations. Let's work through what the 10Q shows. PulteGroup is a United States home builder, and the 10Q splits the group into two reporting segments. Home building is 97.7% of revenue. Financial services the remaining 2.3%. One note on basis because getting it wrong changes every number that follows. Every flow figure here, revenue, profit, cash flow, is cumulative for the first 6 months of fiscal 2026, not standalone second quarter figures, and is compared with the same 6 months a year earlier. Balance sheet items are compared instead with the prior fiscal year end, the 31st of December 2025. For those, the right phrase is since the start of the fiscal year, not year over year. Revenue for the 6 months came in at $7.39 billion, down 10.9% from $8.3 billion. Net income was $819 million, down 27.6%. Diluted earnings per share were $4.27 against $5.60, down 23.8%. Notice the shape of that. The top line fell by roughly a tenth, but profit fell by more than a quarter. That gap is the most informative thing on the income statement. The decline is not simply about selling fewer homes. Something is also happening to the profitability of each dollar that does come through the door. Here is the bridge. Gross profit fell 18.5% to $1.94 billion, and gross margin dropped to 26.2% from 28.7%, a loss of 2.5 percentage points. The mechanism is one line above. Cost of revenue fell only 7.8%, while revenue fell 10.9%. Costs did not rise. Revenue per unit came down faster than the cost of building it, the signature of pricing and incentive pressure, not cost inflation. Operating income then fell 26.3% to $1.18 billion, with operating margin at 15.9% against 19.2%. Net margin finished at 11.1%, down from 13.6%. Compression at every level. Two things widened the fall between gross profit and the bottom line. First, fixed cost. Selling, general, and administrative expense was $763 million, down just 2.6% against a revenue base that fell 10.9%. When overhead barely moves and sales shrink by a tenth, operating leverage runs in reverse. Second, the share count. Diluted shares fell to 192 million from 202.2 million, a 5% reduction driven by repurchases. That is why earnings per share fell 23.8% while net income fell 27.6%. Roughly 4 percentage points of the per-share outcome came from capital allocation, not the business. And no unusual tax item is hiding here. Income tax of $253 million bridges most of the gap between operating and net income. This is operating-driven, not one-off-driven. The segment table offers no place to hide. Home building generated $7.22 billion, 97.7% of the total, down 10.9% year over year. Financial services contributed $169 million, 2.3%, down 12.1%. The dominant segment declined in line with the group, the smaller one slightly faster. No growing division offsets a shrinking one, and no acquisition inflates the base. Total assets rose only about 1% since the start of the fiscal year. This is an organic, broad-based decline across what is effectively a single-segment home builder, with no diversification to cushion a housing slowdown. Now the part that matters most. Operating cash flow for the 6 months was $177 million, down 58.1% from $422 million. Against net income of $819 million, that is a conversion ratio of about 22% versus roughly 37% in the prior year half. Put plainly, close to 4/5 of reported first-half profit did not arrive as cash. For a home builder, there is a mechanical explanation: capital absorbed into land, development, and houses under construction. And the filing does not break out those working capital movements. But hold on to this: cash flow fell more than twice as fast as earnings. That is a widening gap, not a stable feature of the model. The rest of the cash flow statement fills in the picture. Capital expenditure was modest at $55 million, down from $64 million, leaving free cash flow of just over $120 million. A year earlier, that was $358 million. So free cash flow fell 66%. Investing outflows widened to $88 million from $39 million, and financing absorbed $720 million. Together, the company spent considerably more cash than it generated. Capital intensity is not the problem. CapEx is small for this business. The cash is consumed inside operations before it ever reaches the free cash flow line and then distributed at a rate the operating engine did not support. So where did that financing outflow go? Share repurchases of $681 million, up from $600 million. Dividends of $102 million, up from $90 million. Combined returns of $783 million. Against free cash flow of about $122 million, that is roughly 6.4 times. Against operating cash flow alone, about 4.4 times. Read that carefully. Both the buyback and the dividend were increased year over year, in a half where operating cash generation fell by well over half. The difference came out of the cash balance, which brings us to the balance sheet. That balance sheet can absorb it. Total assets stood at $18.26 billion, up about 1.2% since the start of the fiscal year. Total liabilities were $5.25 billion, up 3.7%. Equity was essentially flat at $13 billion, up 0.5%, flat for a specific reason. $819 million of earnings was almost entirely offset by $681 million of buybacks and $102 million of dividends. Almost nothing was retained. Debt to equity is reported at 0.4 times, and equity funds roughly 71% of the asset base. This remains a conservatively financed company. Solvency is not the question in this filing. Liquidity is where the pressure shows. Cash and equivalents fell to $1.34 billion from $1.98 billion at the last fiscal year-end, a drawdown of $645 million, or 32.6%, since the start of the fiscal year. That is simply the bridge between $177 million of operating cash and $783 million of shareholder returns. Returns on capital moved with earnings. Return on equity of 6.3% against 9% a year earlier, and return on assets of 4.5%. Both are half-year figures, not annualized, so read them as direction of travel. The cash buffer is still substantial, roughly a quarter of total liabilities, but meaningfully thinner than 6 months ago. Outside the financial statements, there is very little to report, and that is worth stating plainly. Form 4 filings show 0 open market purchases and 0 open market sales by insiders in the period. No grants, no option exercises, no tax withholding disposals. That is an absence of signal, not a negative one. Nobody inside the company acted either way. The only recent corporate event is the 8K Furnishing second quarter results, filed the same day as the 10Q. No acquisitions, no leadership changes, no financing actions, no guidance events, and no earnings call transcript in the data, so management's own framing is not available here. The one visible capital allocation signal comes from the company rather than individuals. It kept buying its own shares at a pace above last year. So what should you track next filing? First, cash conversion, whether operating cash flow moves back toward net income or land and inventory spend keeps it stuck below a quarter of reported profit. Second, gross margin, whether it stabilizes near 26% or keeps eroding as incentives persist. Third, the pace of returns, whether repurchases moderate from that $681 million half-year run rate after a $645 million draw on cash. Fourth, the home building revenue line, whether the 10.9% decline flattens or steepens. Those four answers will tell you far more than the headline profit number. The takeaway. PulteGroup's first half was a clean but clearly cyclical step down. The composition of earnings is honest, operating-driven, no one-off gains, no acquired revenue, and the balance sheet is strong, with low leverage and over $1.3 billion of cash. What deteriorated is not the accounting, it is the cash. Reported profit is real. It simply arrived far less in cash than a year ago, and shareholder returns were funded from the balance sheet accordingly. Watch the conversion ratio, not the headline. That is the number that tells you whether this is a trough or a trend. Thanks for watching my stock analysis.